Okay, so you can see there by the topic there, Rethinking Sell in May, a smarter approach for JSE traders. The whole idea is to rethink it. Does it apply? Is it still applicable to markets and specifically to the JSE in South Africa? So here's the agenda. There we go. We're going to discuss a bit more about the phenomenon of sell in May. And then we're going to spend more time, most of the time, on alternative strategy, what I call swing trading. It's one of the strategies available. And then we'll just close it off with how to set up your viewpoint for analysis as a swing trader. Okay, so let's get into it. First point is sell in May and go away. We're obviously near the end of May. And we'll see some charts just now how the markets have performed. But as a quick introduction, some historical data. This is obviously for US markets, and specifically with the S&P 500. It gives you a bit of a 74-year history there has been performing. But using that scenario where you sell in May and then go away for 6 months and come back in November, how does it apply? So yeah, the historical data does support that the November to April period, which will be the Northern Hemisphere winter period, generally outperforms the May to October, the summer periods. So I'm going to stick to that scenario. It does get confusing for us, so switching over to the South African market. But you can see there, over the 74 years, or that from May to October, the average return is about 1.8%. The positive returns in 65% of those years, about 49 out of the 75 years, would have been positive. So, so as I say, it's about 1.8%. If you look at the winter months, the average return there is about 6.5%. So it's significantly higher than the summer periods. So over 74 years, the cumulative returns would have been about 35%. For that May to October scenario, that summer period, and the winter period, 1,166%. Okay, so this is interesting to note also that over the last 50 years, the Dow Jones Industrial Average for the October period also gave about 0.3%. And again, that the winter period was much better, giving you 7.5 times that. So yeah, does the historical data, as I say, does support the idea of sell in May and go away. But saying that, how is it applicable to today's markets? So there's pros and cons. There's arguments supporting it and there's arguments against it. Me, myself, I'm against it. You'll see just now. But yeah, you just saw now historical consistency. The pattern is held in many developed markets around the world, as I say, US markets, UK, Australia, etc. But the main thing is also the volatility. The VIX index, CBOE, volatility index often rises from July to October, so it's also a precursor to higher summer volatility. But also, obviously, we look at things like institutional factors, behavioral finance. We look at portfolio rebalancing, especially from the unit trust guys, and window dressing, and obviously also the big thing there is investor psychology, which all influences the stock scenario. Right now on the markets in the 2025 context, we've seen that obviously these tariff disputes, one day on, one day off, as this creates a lot of uncertainty, creates a lot of volatility. There's a lot of geopolitical tensions going on. We've got wars going on, and we've got a lot of inflation concerns and things like that. So it's not an easy market to read right now. But again, weakness beginning of the year does align to weakness in summer. So you can see the years that we had negative year-to-date returns. For example, the data I had looking at was for S&P 500, we're down 5.4%. You'll see a chart just now that updated with more information. So yeah, there's 4 criteria there we can look at, or 3 main criteria. But the argument against it is diminishing returns. You know, markets have become more efficient, and people are more aware of these patterns. And so its predictability has weakened over the years. The main thing also, I believe, that you missed out on opportunities. If you had stayed and invested from 1975 to 2024, you'd have got $340,000 if you had invested $1,000 over that time period. If you had sold in May and used that strategy, you've only had $64,000. You can see the big difference there. So the main thing is you're missing out on opportunities. The fundamentals and obviously macroeconomic factors, and there's a lot of other geopolitical events are playing a bigger role in the markets. So, you know, the seasonal movements slowly being pushed to the back burner. And also obviously sector and market variance, you know, technology and the consumer discretionary sectors perform better in summer. But also things like non-US markets, like Oslo Stock Exchange, may not align with the strategies. So not all global markets will be with it. And that's gives you the idea of being geographically diversified. And then the main thing for me is obviously if you buying and selling, especially as an investor, first of all, you got frequent trading costs, and also you got tax implications, which will impact on your returns. So remember, you're out of the market for 6 months of the year if you had to use a strategy. Go one step further. As I say, you look at 225, the market conditions. The S&P 5 was down 5.5% in year to date in April. Did bounce back. We'll talk about it just now. But I mentioned just now about the volatility. VIX was around about 25. The long-term average is about 20. It has come back below that at the moment. So volatility has slowed down. But again, that historical data does support a weaker May, October performance in years starting with a negative returns. But I think the markets have been skewed a lot this year with Donald Trump's Liberation Day tariffs, and you'll see some slides just now. And that leads to my next point there, policy uncertainty around Donald Trump. So yes, a lot of these things will only expire in July 2025. But it's still creating a lot of volatility, which is, as I said just now, creates that uncertainty. And also, you know, it does lead credence to the strategy relevance. But I believe that the bull market still persists. And yeah, so the strategy basically is ineffective. And then you also got things like the experts, you know, they strongly advise against a full exposure, exit out of the market. You know, you got things like deregulation and tax cuts and things like that does limit the downside risk. But Warren Buffett has always been a long-term investor, and obviously market timing. So rather stay invested would outperform most long-term challenges. That's if you're an investor. If you're a trader, different scenario. We're talking about that in the next few slides. So here's the graph. This is the S&P 500. You can see there that this is from 1st of January. We had this little rally up, and then the market pulled back a bit, and then we rallied up to newer highs, and we basically formed like a triple, or nearly a triple top, and then the market pulled back a lot. And then 1st of April or 2nd of April, so when Donald Trump announced his Liberation Day tariffs, and the market dropped. But you can see from the 1st of January to that 7th of April low, the market has fallen 22%. Sorry, it was the right-hand side there. It's fallen 18%. It took 70 days to do that. And since then, as I say, I believe it was an overreaction by the market. The market recovered because obviously Donald Trump flip-flopped on his decisions there. The market bounced back. And you can see there from the 7th of January to more recently till today, the market has bounced back 22%, and that's taking a shorter period to bounce back. Okay, so that's just, I'll show you a graph just now of the JSE All Share, very similar, but you can see how the market reacted. But you can see for a long time, the market, we did start off positive, and then we went higher, and then since then we've had this recovery. But I still believe we're in a bull market for the US markets. The JSE context, JSE All Share context, there's a lot of things that obviously we don't have a lot of information, but it does exhibit the same kind of pattern. November to April returns about 7% higher than the May to October. So at the end of the year, we talk about the Santa Claus rally. So yeah, that's part of it. But positive summer, which is our winter returns, is roughly about 60% over the years. And obviously in our summer period, I'm just flopping out. I said I won't, but it does get a bit confusing. But you can see the winning and losing years as roughly about 8%. That was a .com. We recovered from that. The global financial crisis back in 2008, 15%, recovered from that. And then obviously we had the 2015 commodity slump, which is about 5%. And our strong summer months, summer periods, 2009, that's post crisis, the global financial crisis. The market rallied more than 20%. And then more recently, the COVID pandemic, we rallied 18%. Okay. So yeah, there are also things, and our markets are heavily influenced by mining and financials, and obviously that has ties to the commodity cycles and global risk. So yeah, it does amplify and mute seasonal effects in that context. Here's a graph of the, this thing supporting it is the seasonal patterns, and then obviously volatility. But again, there's a lot of other factors that also we face. I think right now our biggest problem is weak economic growth, not so much the load shedding at the moment, but we still have some political uncertainty, even after last week's little meeting in the White House, but also the currency volatility. That'll always be with us for a while. Okay. There's a graph of the JSE All Share, very similar. We started the year strong. We had a similar, we followed what happened in the S&P 500. We had this little pullback. It bounced off that yellow line there, is the 200-day moving average. It bounced up higher, and we made new highs. We had a bit of a correction again, taking some profits. And then it was very similar again. Donald Trump made his little announcement. The market fell back. But over that time period, from the 1st of January to the 7th, our market was down 8.2%, so not as bad as the US markets. And since then, our market has recovered, and we're up to, again, 22%. We're back in a bull market. Every day, new highs making new highs. So we're in a full, strong bull market. Okay, so that gives you a bit of context. So the way I look at it, things have changed a bit. I rather look at the charts. I can't see myself being out of the market for 6 months at a time. It was more the institutional guys, etc. So let's look at a better approach to the market and swing trading. Swing trading is right in the middle between the day traders, and on the other side of the square, that side of the thing is what we call the position traders. Swing traders in the middle. Most of you guys will be swing traders, hold it from a few days to a few weeks. The average I found is about 12 days. But anyway, the whole idea here, the fundamental principle around swing trading is the markets really go up and down in a straight line. They swing back and forth as they get to where they want to go. We talk about a bull market is a higher high and higher lows. That's an uptrend as a bull market. And we have a bear market, lower highs and lows. That'll be a downtrend. So just looking at some cycle analysis there. But the main thing about it is market psychology. And that's how people think about the fundamentals, how they feel about the fundamentals of the economy, the market, the sectors, etc. And that obviously creates the natural swings that traders continually act and react with. The best thing for as a swing trader is to use technical analysis, charts, to help you understand market cycles and the patterns, and that's your goal as a technical analyst, is to look for those patterns and see if they get repeated. And we use these as turning points in the market and to get involved in and out the market. So commonly used tools would be moving averages, some momentum oscillators or technical indicators like the RSI, stochastic. I like to use the MACD, moving average convergence, divergence indicator, but also like to use drawing tools, more visual, highlights support and resistance levels, that highlights also price action. If you had to go onto Google and go Google swing trading, you'll find a lot of information, a lot of videos. One of my favorite websites is investopedia.com. You'll find a lot of information there, and that's where I got this from. There are various strategies you can use. I'm going to go through all of them. I'm going to highlight what I use the most, the one right at the bottom there, breakout trading. But the main idea here with trading, you'll see in the next few slides, is to have entry point and the exit point but the charts tell you where to get in at the market. Okay, so the more visual you can make your analysis, the easier it becomes. Okay, so trend pullbacks, a lot of these things will overlap. You know, trend pullbacks, I'll use Fibonacci also to highlight for me. I use Fibonacci a lot. The old golden ratios, I used to talk about the 23.6. The one you find out that happens a lot, the market always pulls back to these levels, is about 38.2%. That is very, very common. The one I use a lot also is the 50-day, 50%, which is not a Fibonacci level, but it does, the market does pull back quite consistently to those levels. Okay. A lot of times also you want to coincide, if it pulls back to moving averages, it gives you stronger evidence. That's a turning point, and that's what we're looking at. I use chart patterns a lot, especially what we call rectangles and continuation patterns in the form of rectangles and triangles and pennants and flags. Those are continuation patterns. Tells you that the trend continues on its initial path. It also tells you where it's going, so you can measure. You can do the opposite, also use reversal patterns like head and shoulders, formations, double tops, and bottoms, etc. I just like to use continuation patterns more. You'll see some examples just now. So that fits in with what I like to use is called breakout trading. This is where we target shares that have a considerable price movement from a narrower range. So the market, we have a sideways market within our uptrend, so the market consolidates, takes a bit of a breather, waiting for new information, and then the new information comes out, it's positive, breaks out above the previous resistance level, but continues on its initial path, and that's what we call a breakout trading, a strategy. Obviously, the opposite occurs, breaks through support, you would go short, take advantage of falling markets, but you trade in the direction of the market. That's the main idea. Okay, so how do you find these candidates? The best thing to do is to create a watch list of potential winners, especially if you're trading single stocks and CFDs. You can only trade the top 100. So out of that, you maybe create a list, a potential watch list, maybe 25 stocks, have some banking stocks, some mining stocks, etc. And then you do all your analysis on those companies and you save those trend lines and things like that. But on a daily basis, you'll be watching it to wait for that breakout, and that's where you have to have some patience. You can see right at the bottom there, you have to be patient with the strategy. And you want to set a reasonable price objective or target price or take profit price. And the charts, I believe it always gives you those kind of numbers. And sometimes the market breaks, the price will break out and then comes back and retests at the previous resistance level and then kisses it goodbye and then runs. Okay, so with this strategy, you need to know when does a pattern fail, and that's why it's important to have a stop loss. Okay, so there's certain numbers that you need to know. In this scenario, I was talking about the three numbers. You need to know the entry price, your entry point. This is where you enter into a market position. So it's usually either you're going to be buying, you're going to go long, especially if you're using single stocks or CFDs, or you're going to go short, take advantage of falling markets. But you use those entry points based on your analysis, and you will see so in the graph just now. So before putting on the trade, you need to know, is it worth it? So you do what I say, do the paperwork first. Okay. So usually a breakout will be your trigger, and that's how you would start looking at the trade. Also very important that before you get into a trade, you need to know, where am I going to get out if the market goes against me? That's where your stop loss or your stop price comes in, your SP. And the main idea here with trading always is not about making capital, not about making money, it's avoiding capital losses. So yeah, this is very important. It's predetermined price levels before you even enter the market. You know where you're getting at, and then take price, the target price, or take profit price. Again, your charts will tell you where to get in, and it's not just randomly. The charts will tell you where to do that. Okay, so that's the three price targets of price numbers. What's also important to know is the managing the risk numbers. You need to know your risk reward ratio. So you need to calculate this just to make it worthwhile. you basically calculate the potential profit by the potential loss. So whatever your profit is divided by your stop loss, and that will give you your what we call the risk reward ratio. So, for example, a risk reward ratio is 1 to 3. Basically, indicates a favorable trade. I'm willing to risk R1 to make R3. So it just tells you that it's a good trade. And then there were some of these other little numbers you can look at, 357. These are just trading rules that you want to use. The 3% rule, and that varies. And some people want to say, I don't want to risk more than 1% of my total trading capital on a single trade. Some people say 2%, some people say 3%. So it's between 1 and 3%. So if you have a trading account of 100,000 Rand, in this scenario, you should never risk more than 3,000 Rand per trade. And you'll see on my example just now how you'll do it. And then the 5% limit your overall exposure to all open trades combined to 5% of your capital. And then the 7% ensure that all your winning trades generate at least 7% more profit than your losing trades. So you will have some losing trades, but the idea is that over the long term, you should be making profit. You should never, ever, ever have a big loss. Okay. So here's a scenario. This is BTI, just example. This is a sideways market. You can see it was trading below its 200-day moving average for a long time, and consolidated, found a bottom, bit of an island, and then we had this little sideways market, and then moved above its 200-day moving average for the first time for a long time. But you can also see there that it's broke up through all these, moving my cursor in here, resistance levels. Okay, so you can see it touched quite a few times there, the little resistance zone. So say there's the moving averages. So you can see it making higher highs, higher lows, and higher highs. So there's a bit of a changing market here. Yes, you could see the same thing here, but what's important is this breakout here. That was very strong. So it touched a few times. But if I measure, and this is why I like this chart pattern. It's very easy to look at. I measure from the difference between the two of them, and here we talk about 40 Rand. So I would have bought it at 590. Whatever the difference was, I add on to that, into the 590, gave me the target price of 630. Yes, with hindsight, I can see it went up further. So it's still great. I would have brought my stop loss up higher. But all it is, I'll just put my stop loss halfway through that, and that would be roughly about my moving average coincides with this previous support there. Okay, so roughly about there, what would be my stop loss, which is 20 Rand. Remember, I want to risk R1 to make R2. So as long as my ratio is 1 to 2, okay. So there we go. That's how we talk about the stop loss. 20 Rand less is 570. Okay. So let's look at some of the numbers. How would it apply? Let's get rid of this again. There we go. So in this scenario, I'm using CFDs, contracts for difference. My entry price was 590 at the bottom here. Remember the scenario. Okay, 590. 40 Rand difference, I add on to that. Remember the scenario? Okay, so 590, my target price 570, my stop's 570. The difference between that and that is my 20 Rand. My reward is 40 Rand, so that provided by giving my risk reward ratio of 1 to 2. Okay, so I'm using 100,000 Rand trading capital. 3% of that is my 3% risk rule is 3,000 Rand. So whatever that is divided by my stop loss, my risk, is 20 Rand. It tells me how many shares to buy. So this is what we call position sizing. So I can go buy 150 shares. So on the CFD for a long position, remember I'm buying 150 shares at 590. My exposure would have been, bring this back again, would have been 88,500. Okay, the brokerage for CFDs is 0.45%. That's 398 plus VAT. So that would be in the opening leg of the transaction. My initial margin, remember the top 40 stock, so it's only 15%. So 15% of my exposure, I only would have put down 13,277 Rand of my own money to have 100% exposure. Okay, if I had to close out, if I had to close out at 630, it could have gone higher. So you wrote it. I would have brought my stop loss higher up to my to this level, then right up higher. But you can see the scenario here. 150 times 650, that would be my exposure. But bottom line, my costs, okay, there's my profit. So I would have made 5,000 Rand gross profit, sorry, net profit. Okay, gross profit would have been that. there's my costs, there's my my net profit. So I made 5,000 Rand net profit divided by the money I put down. I made 38% in a very short period of time. Okay, and that's why single stocks and CFDs are so popular as a swing trading mechanism, because it's capital efficient, number one, and number two, it's more affordable than trading normal shares. Okay, so I'm going through this very fast because I know we've got a lot of slides to go through, but whoops, let's look at the next one. So there's pros and cons. Obviously, compared to day trading, it doesn't take so much time, but also you can maximize your short-term profit potential by grabbing the majority of the market swing. Okay. The disadvantage, obviously, is that you're holding a position overnight. The day traders don't like to hold a position overnight, but this is where you can, on the system, you can set up a contingent order. If the market drops, you're getting out. Okay. So it does take a bit more time than long-term investing, because you have to watch the market on a daily basis. Okay, so I sort of just put this part in just to highlight how you can use the tools. So if you're a client with PSG and you've got an equity account or a CFD account or single stock, you'll have access to the trading platform, which is Viewpoint Plus. So when you first log into your account, by default, when you've clicked on that Viewpoint tab and it opens, this is default. You'll have portfolio, watch list, and order pad. I suggest that you can reconfigure it. You close this tab, you click on this little button over here. Okay, you click on that little button there, it says close the widget, remove the portfolio. You don't need it right now. And then you'll get the scenario where you have two screens. Oops. Okay, you'll have two screens. There we go. And then on your watch list, okay, we're on the watch list now. I can't remember, I forgot to highlight this for you guys, but you'll see there's like a thing in the top left-hand corner here, like a table, like a square with a lot of squares inside. You click on that, it opens up this. This is where you can reconfigure all the different columns. And I suggest that you reconfigure it, make it more applicable. And the idea here is to set the watch list up for a fundamentals, call it that. So what I do is, first of all, click on exchange, and I go click on the little button here called hide. Okay, it removes it. And then from this list here, your PE, I click on fixed. Okay, oops, fixes. I click on fixed to add it onto the first column. And then from this list also, you scroll down and you look for yield, historical. This is your historical dividend yield. And you also add it to fixed. And then down this list here, because some of these things don't really apply, I like to hide bases and status. It just makes the watch list a bit more easier to manage. And then what I do, I forgot to do this here on this slide, I use last and I move it right to the back, to the end. Okay, very important that you click on save changes. But anyway, this is what it would look like when you're finished. Okay, so you'll have your two columns. There's, as I say, that's last. I forgot to move this here, but that would have been moved right up back there. You can see the PE ratio and the yield. This is the top 40. By default, the watch list is the top 40. So what's important now, if you click on these little buttons up top here, you'll see if you click on it, it's called a broadcast group. Okay, so you select the color, make sure the color is the same. And what I did now in the previous slide, okay, you would have had order pad. And what I've done now, if you click on this little button here, it pops up of a table and it says replace widget. So I've replaced the order pad widget with the chart. Okay, then I selected the broadcast groups, and you'll find that they're linked now. So if I double click on JSE 200, which is the top 40, it automatically will bring up the chart. Okay, so that's linked. So what I've done now, I've configured the watch list, as I say, for fundamentals, but I've also linked them together. So wherever I look in the watch list will be my charts. Okay, so then with the charts, and also you can see I just moved the watch list over a smaller bit to the left, and all I want to see is the PE and the dividend yields, and I can click on these columns here and rank them. So I want the lowest PE and the highest dividend yields. That's one way of looking at it. Okay, whoops. So the idea is to find companies that are undervalued, that are profitable. This is where the fundamentals will come into it. I like to do the fundamentals and the technicals together, what I call rational analysis. Just bends the odds in my favor. But if you click on along the top here, you've got indicators. I suggest select popular. You can see in this graph here, I've selected the moving average cross. So it gives you the 20-day, the 50-day, and the 200-day moving average automatically. And I've also put the MACD at the bottom. If you want to, you can go click on volume and go look for the volume chart at the low of volume histogram at the bottom. Okay, so that's just a quick way of helping you to make analysis, make decisions, and obviously you can chop and changes. Once you start playing around with it, you'll see that there's RSI, there's stochastic, a bit more short-term indicators. Okay, so I know I've gone through this very fast. I will have more trading webinars going forward. This was just a precursor, a bit of a touch. Go into more detail a bit later. So quick summary. Obviously, historical data does support that idea of selling may go away, but it is questionable. As I look at it right now, there's more market efficiency now and things like that. So it does apply to South Africa to a certain extent, but there's a lot of other things happening also. So I don't just go over market cliche. It's the same as the Santa Claus rally. It doesn't always happen. It's just a cliche. Okay. But the main thing I wanted to highlight was the swing trading strategies, and I highlighted for you one strategy called breakout trading. You go Google that, and you'll find a lot of information just on one strategy called breakout trading, which is part of a swing trading strategy. Remember, those numbers are important: entry price, TP, the target price or take profit, and stop loss. Those are the three numbers you need to know before you're putting on the trade. Also need to know your risk numbers, okay, especially your risk reward ratio. And then secondly, also you need to know your 3% rule. You do that, you start to bend odds in your favor as a beginner, as a novice trader. And I can tell you now, you start making better and better winning trades. So guys, hopefully that made sense to you guys. Going forward, you might look at a CFD account if you haven't got one. As I say, it's a great way of looking at the market. It's more capital efficient, and number one, and because of the gearing, the leverage. If it's a top 40 stock, you only need remember the exposure, as long as it's 25,000 times 15%, that's the top 40. It's about 3,750 Rand. That's the minimum you need to put down. If it's a mid-cap stock, you need to put a bit more down. Initial margin, 17.5% is about 4,000, I think it's 4,000 something, I can't remember offhand now. Anyway, a bit more, okay. But it's more capital efficient, number one, and number two is it's more affordable because I say it's only 0.45% from a brokerage cost point of view. Okay, as I say, this webinar is being recorded, and hopefully I'll be able to send it out by latest by Friday. Okay, so let's see what kind of questions you guys got. There's a question from Tabo. Tabo wants to know, will this swing trading apply to single stock futures too? Yes, Tabo, exactly the same thing, exactly the same way. Obviously, I worked out position sizing to be 150 shares. In our example, remember, single stock futures is the minimum as a contract, 100 shares is a contract. So in that scenario, we bought either one contract or two contracts. Okay, so it's up to you. But I would have gone for two contracts. So yeah, to answer your question, Tabo, it explains exactly the same way. Are there any questions? Other questions? Cool. Doesn't look like it. Okay, guys. Well, from my side, thank you very much for being on this webinar. As I say, we had some technical hassles, and hopefully you got some value out of it. But from my side, any questions you guys have, you're welcome to drop us an email at wealth@psg.co.za, or call us on OneStream 0868 000 368. Myself or one of my colleagues will be able to help you, any questions you have. But until next month, bye for now.